Welcome, everyone. Today we will examine the global financial crisis of 2007 to 2009, the most severe financial and economic crisis since the Great Depression. We will review the timeline, the parties involved, what happened, why it happened, how it unfolded, how it ended, and which countries were affected. In 2007, rising defaults on subprime mortgages in the United States started to shake confidence. Hedge funds and smaller banks began reporting significant losses. This was the beginning of a much larger global crisis. In March 2008, Bear Stearns, one of the largest investment banks, collapsed under the weight of mortgage-backed securities. It was acquired by J.P. Morgan Chase with Federal Reserve support. September 2008 was the climax. Lehman Brothers filed for bankruptcy, triggering panic. AIG required a massive bailout, and global stock markets collapsed. This month is often remembered as the heart of the financial meltdown. In late 2008, the U.S. government introduced the Troubled Asset Relief Program, or TARP, injecting hundreds of billions into banks to stabilize the system. Central banks around the world cut interest rates to near zero. By 2009, the global recession had deepened. G20 countries coordinated stimulus measures, central banks expanded liquidity, and efforts to stabilize economies took hold. Signs of recovery began in mid-2009. The crisis involved many players. Financial institutions like Lehman Brothers, Bear Stearns, AIG, Citigroup, and Goldman Sachs were at the center. Regulators included the U.S. Federal Reserve, the Treasury, and central banks worldwide. Investors included hedge funds, pension funds, and retail investors. Millions of households were directly affected through foreclosures and unemployment. International bodies such as the IMF and the G20 also played critical roles. The crisis began in the U.S. housing market. Risky subprime mortgages had been bundled into mortgage-backed securities and sold globally. When defaults rose, these securities collapsed in value, creating huge losses. Banks faced liquidity shortages, and global financial markets froze. Several causes stand out as to why this crisis appended. Subprime lending was excessive. Complex financial products like collateralized debt obligations obscured risk. Banks and households were over-leveraged. Regulators failed to provide adequate oversight, and global imbalances fueled cheap credit. All these factors combined to create systemic fragility. Mechanically, mortgages were packaged into securities and rated highly by agencies, misleading investors. When housing prices fell, defaults spiked, and these securities became toxic. Lehman Brothers collapsed, AIG needed a bailout, and interbank lending froze. Credit dried up, businesses shut down, and unemployment soared. The crisis ended with unprecedented government and central bank interventions. TARP stabilized U.S. banks. The Federal Reserve and European Central Bank cut rates and provided liquidity. G20 countries rolled out fiscal stimulus. By mid-2009, stabilization began, but recovery was slow and uneven. The United States was the epicenter, with a housing collapse and severe recession. Europe experienced deep banking crises, especially in the UK, Ireland, Spain, and Greece. Export-driven economies in Asia, such as Japan and South Korea, suffered from declining global demand. Virtually every major economy was affected by the shock. The global financial crisis of 2007 to 2009 demonstrated the dangers of excessive leverage, weak regulation, and interconnected markets. It reshaped financial regulation globally, leading to reforms such as Dodd-Frank in the U.S. and Basel III internationally. For finance professionals, it remains a central case study in systemic risk and crisis management. This concludes our discussion about the global financial crisis of 2007 to 2009. See you at the next lecture.